Welcome back. I am Mr. Fleming. Here we go with episode 7. I've showed you kind of what different investments there are, the huge benefits of compound interest in starting earlier in your life. This episode, we're going to talk about index funds. So, here we go. Brief disclaimer, per usual. Okay, index funds. I taught you last time that basically if you can hit a certain return, you're going to basically end up with a ton of money the earlier you start investing and paying yourself first in your career. So now I need to show you how to do that. So fortunately, I don't have to come up with a very labor-intensive strategy for you to follow. Somebody else has already come up with a shortcut, and that shortcut is primarily what I follow. And that's why I'm trying to share this with you. So who came up with a shortcut? John Bogle, who is the founder of a company called Vanguard, made up what's called the index fund. An index fund was designed to replace the standard mutual fund in hopes of lowering the fees, which can be a huge negative impact on your returns or your growth of your money, to deliver better returns to investors, because typically index funds beat the average actively managed mutual fund, which means somebody out there is trying to buy and sell stocks or equities or different assets, bonds, etc., to hit a return. So we'll show you what it is and why it beats it. And then just to simplify the investing process for the average investor who doesn't have time to do the research and actively be engaged in managing a portfolio every day. So what is an index fund? Well, the easiest way for me to understand it, I think for you to hear and have it be explained to you, is take a look on the graph, the pie graph on the right. So if you're looking at the aggregate whole of the entire market and you know the sizes of the different companies, okay? The size of the company is going to represent a percentage of the size of the entire stock market, or the values of all of the companies in the entire given index, which might be America or Asia or Europe or the entire aggregate, all of them, okay? Many people start with an index fund that exclusively focuses on American companies. So for the sake of that example, we're going to look at this chart here, or this pie graph, which is based on the S&P 500 at a window in time. Now, if you're looking at this, you'll see that Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, JP Morgan, these are all comprising a sizable but relatively small percentage of your index fund. And as companies get larger, they will comprise a larger piece of your index fund. If the company declines and gets smaller in its value, then they will represent a smaller amount in your index fund. The beauty of the entire thing is you do nothing. They manage the entire thing for you with computers based on the size of the companies and the percentage of size they represent within the index, the given market that we're taking from. So in a nutshell, you're allowing computers and the success of different companies to be balanced out and let the winners win and the losers lose. And you don't have to try to pick the winners. You can just bet on the entire market increasing over time. And historically speaking, the market has increased. Whether there be inflation, deflation, a variety of circumstances, long term, the market has increased. Short term, there are little deviations and changes that we'll talk about and teach you how to deal with in our next episode. But this is a proven strategy to simplify and make it easy for you to passively invest, not actively invest, and generate great returns with low fees. So this really is my suggestion to you, my opinion, not called opinion, whatever, to you to consider to simply easily hit returns without having to have a vast expertise and do a tremendous amount of research to hit probably not as good of returns, which takes me to the next thing. So your choices. You can actively manage your accounts, meaning you can try to choose stocks, Bitcoin, go crazy, do all the different things you think are going to double, triple your money year after year. But I think you'll find if you do some research that you're competing against geniuses with 300 to 500 people at their disposal, the best technology, the best equipment, the best computers. That's who you're competing against. So before you undertake that vast, challenging endeavor, you might consider understanding what you're up against and knowing that if you invest in an index fund, you're probably going to outperform 95% of active managers, people that have PhDs, master's degrees in financial accounting and management. So that's just my brief disclaimer on maybe why actively managing your account might not be a good idea. So that brings us to the next choice. You choosing your own mix of index funds, meaning you can choose from a different combination of index funds. I implore you to go on to Vanguard's website or a number of other iShares websites to look at different types of index funds available to you. I recommend Vanguard, but I'm biased towards Vanguard. They created the index fund and there's no fees associated with purchasing them on that site. So every time you invest in your index fund, you're not getting charged for it. So a lot of perks to it, but you do your own research, come to your own conclusions. As far as choosing a mix of mutual funds versus choosing a target date fund, which is option number 3, choosing your own mix means that each year you're going to need to rebalance the different funds that you have, and you're going to need to actively be aware of what you're capable of tolerating in terms of how much your money goes up and down in value year in, year out. We're going to have to explore that and your what's called a risk profile, meaning your ability to withstand maybe possibly seeing $500,000 turn into $300,000 in like a month. Like in this previous pandemic market situation, if you had $1 million, it would have turned into $600,000 in a month. How would you have dealt with that? So there are different types of risk profiles to help you decrease possibly your return, but also decrease your drawdowns in those situations to help you not get scared, freak out, and make bad decisions that might lead to negative impact as far as your returns long term. So that brings me to option 3, target date funds, which if you look at this graph to the right here, and you take your time to interpret it, maybe later pause this video and just take a look at it more, but you can see in the different portfolios based on our age to retirement, our retirement age, post-retirement, you see bonds increasing and growth stocks decreasing with each passing year you get older. In a nutshell, what this is doing for you, all of this is being done for you, is it's decreasing your risk and also decreasing your return the older you get. But that's taking into account that you have more money and you're going to have less volatility or lower drawdowns when you get older. Because sometimes when you're 65 years old and $10 million turns into $4 or $5 million, people have heart attacks, bad things happen. They don't come back, they stop investing. So that's to protect you from you in major negative market situations. I'm going to take you to Vanguard's website right now and let you just kind of take a look at what you might be doing to explore different target date funds. So if you go onto Vanguard's website or any other brokerage website, and this is completely up to you, not my advice, just simply how I've explored this situation. As we're looking at the screen here, there are different target date funds based on your guesstimated retirement time period. So many of you watching this, if you're in high school or young, would be looking at 2065. So 45 years from now, if you graduate high school and then you've got 4 more years and you work for, approximately 40-ish years, give or take. So with that being said, if we're looking at this portfolio, we can see here stock and stock, bond and bond. This is comprised of a combination of international and United States or domestic stocks, which account for approximately 90% of the portfolio. So 90% stocks, which is what's considered an equity-oriented or aggressive return-oriented portfolio, and 10%-ish bonds, which is your protection. Usually bonds go up in many instances when stocks go down. So that's going to protect your volatility a little bit when you're younger. And as you get older, it's going to start to have more bonds and less stocks to protect you from huge volatility as you get older. Explore that, educate yourself on this, read some, figure out your options, but start to come up and think about a plan that you might act upon when you start to have money you're able to invest in. Because the earlier you start, as we saw last episode, the better situation you're going to be in with each passing year and the more options and the more financial freedom you're going to have. So that's what the whole show episodes are about. Okay, finally, just to reiterate, I would invest in your education. Make sure you understand everything that we're talking about. Explore it, learn about it. The earlier you start, the better. Index funds is a great option. Many people have become millionaires knowing minimal about stocks based on investing in index funds. Next episode, we're going to talk about your ability to deal with risk, your ability to stay in the market, and to overcome the biggest challenge in investing. So, hope you learned something. See you next time.